Should you buy Tesla stock before it splits? Tesla is expected to split its stock again in the not-so-distant future. According to industry analysts, the disruptive automaker is growing at a much faster rate and achieving higher margins than the market's established players. And also, Tesla trades at a significantly higher valuation compared to its rivals. Before we begin, please do give us a like and subscribe to our channel for more content like this. The market leader in electric cars is preparing for another stock split, which could spark another surge in confidence among ordinary investors. Tesla announced in a regulatory filing at the end of March that the company plans to conduct another stock split in the near future. There are a few details provided about the plan, but the filing does imply that the action will pave the way for the Tesla CEO Elon Musk's company to start paying dividends in the coming year. Tesla's stock was last split in August 2020 when the company exchanged 5 shares for 1. Tesla's stock price increased by more than 80% between the announcement of the move and its completion. Is it a good idea for investors to buy a share of this industry innovator's stock before the next stock split? Tesla is experiencing explosive growth. Tesla revealed yet another period of exceptional growth in its first quarter earnings report, which was released earlier this month. And in the third quarter, automotive sales increased by more than 87% to $16.86 billion, while net cash flow from operating activities increased by 143% to nearly $4 billion. The company produced 305,407 vehicles and delivered 310,048. Tesla's cars have been high in demand, and the company has profit margins that are above average for its industry. When compared to other manufacturers, Tesla has the highest operating margin, and the company is ready to expand into high-margin sectors, such as battery technology and self-driving software licensing. As a result, Tesla should trade at significantly higher prices to sales as well as higher prices to earnings than the car industry's stalwarts. However, how much of a premium it deserves will be weighed against the other factors that investors will consider. It's important to remember that while the electric vehicle market is rapidly expanding and creating high-margin business opportunities, the automobile industry has been historically highly competitive and low margin. Tesla's market capitalization is currently approximately 4.4 times that of General Motors, Ford, and Volkswagen combined. Tesla has been recording much higher sales and earnings growth than its primary industry competitors, but the company's top and bottom lines continue to lag behind each of these competitors. When the results of General Motors, Ford, and Volkswagen were combined over the previous 12 months, the cohort generated $559.37 billion in revenue and $46.16 billion in net profits, for a total of $561.16 billion. The company made $53.82 billion in sales and $5.52 billion in profit. During the same time period, investors must decide whether Musk's company is worth the valuation premium, given that the electric vehicle market and its adjacent industries are expected to become more competitive. Approach Tesla with a clear understanding of your own personal risk tolerance. Despite the fact that Tesla is unquestionably the industry leader in electric vehicles, its stock is still regarded as a high-risk investment. If you have a high-risk tolerance and believe the company will continue to produce excellent results in the areas of electric vehicles, batteries, technology, and the autonomous vehicle software, it could be a worthwhile long-term investment. By the way, if you like what you've seen so far, leave us a like and subscribe to our channel to see more content like this. Going back, so far, the corporation has done an excellent job of convincing critics of its superiority. Affluent investors who don't want to take on additional risk or volatility should avoid the stock, and it would be foolish to buy another stock just because of the impending split. Even if electric vehicles are a rapidly growing industry, there may be some twists and turns ahead that could cause the market to reassert Tesla's highly growth-dependent value. Tesla shares fell 20% in a single week, wiping out $125 billion from the company's value as CEO Elon Musk focused on acquiring Twitter. According to Forbes, Musk is worth $1 billion, despite owning only a 21% stake in Tesla. It's unlikely then that Musk's Tesla shares will be sold in large quantities as a result of this Twitter transaction. Dan Ives, a Wedbush analyst, wrote in a Friday note that the shares would instead be pledged as collateral for loans. It's also unlikely that the current Twitter issue will have an impact on Tesla's stock or Musk's priorities. Musk's Twitter acquisition appears to be appealing only to right-wing Twitter addicts and commentators who feed off their energy, not to employees or investors who rely on Musk's stability and ability to concentrate. More reasons to believe the deal is doomed include Musk's ongoing trolling on Twitter and the naivety of his free speech rhetoric in the face of immovable impediments such as Apple's App Store standards and EU privacy rules, among others. Tesla is now more valuable than the entire automobile industry. Tesla's first quarter earnings were also very impressive. Elon Musk even advised changing materials and focusing on manufacturing for the rest of 2022. The company was able to keep up with the rate of inflation. On Thursday, shares increased by 6.9%, according to market trading. On Wednesday, the stock dropped by about 5%. A record $3.22 per share was earned from $18.8 billion in total sales, the highest amount ever for Tesla. On Wall Street, a profit per share of $2.20 to $2.30 was expected from sales of $18 billion in the fourth quarter of 2021, with $17.7 billion in sales. Tesla's earnings per share were $2.54. Operating profit was a record-breaking $3.6 billion, exceeding analysts' expectations of $2.6 billion. Tesla's sale of regulatory credits, which it receives because it produces more low-emission vehicles than it should, contributed significantly to the surprise. Revenue from credit card transactions was $679 million, far exceeding analysts' expectations of $312 million. A record operational profit was achieved even if credit sales were excluded, and inflation was expected to have a negative impact on the company's profitability from the fourth quarter into the first quarter. A basket of metals used in electric vehicle batteries saw a price increase of nearly 70% in the first quarter compared to the fourth. And that just about brings us to the end of this video. Don't forget to like the video, subscribe, and leave a comment below to let us know what you think about this news. See you later.